Seven Hills Realty Trust. We are a commercial mortgage REIT. We're based here in suburban Boston, and we are part of the broader RMR Group, which is an alternative asset management firm solely based on commercial real estate, approximately $40 billion of assets under management. And Seven Hills itself, currently about $700 million of AUM, current market cap about $200 million, and we are traded on the NASDAQ exchange. So Seven Hills, we make commercial property loans, generally in the range of $20 to $75 million, generally loan to values in that 65 to 75% range. We lend in what we call the middle market, and this really is the most liquid segment of the real estate market, loosely defined as asset values under about $100 million. All of our loans that we write are floating rate, senior secured loans, generally 3 to 5 years, including extension options. And borrowers like the flexibility that our loan program affords them, allowing them to be nimble, not locked in to a long-term loan that they might have be subject to early repayment penalties, like many of the fixed rate loans financing programs are. So we typically provide, it's value add financing. It's generally an acquisition, sometimes a refinance of a property. Oftentimes we're providing additional capital, additional loan advances for the improvements to be made to a property. For instance, we may provide capital for the acquisition of a multifamily property where the borrower is going to acquire the asset, and then they have a business plan to improve the asset. And that might be through remodeling the units or some base building capex, et cetera, in the efforts to increase revenues at the property, thereby increasing values at the property. At the end of their business plan, then they would simply refinance us or sell the asset, and then we would repatriate the capital to the REIT, and in turn make an additional loan as repayments come in. Other property types that we finance, industrial, self-storage, student housing, grocery anchored or neighborhood retail centers, medical office buildings, hospitality, select service hotels, et cetera. And we're comfortable across all these asset classes, really because our broader organization at the RMR Group is an owner and a manager of these assets, which provides us really unmatched expertise as we look to finance these assets. As a general, we like the risk-adjusted returns here that we can generate as secured debt. Unlike equity REITs that you may be familiar with, which own 100% of the equity in a property, as a first mortgage provider, Seven Hills is senior to the borrower's equity. And if we lend, for example, say 70% of an asset, that means that I have a 30% equity cushion in front of our position. In a worst case scenario, value would technically need to drop 30% before we're impaired. And so while we don't participate in the upside or the value creation of the asset, our downside is protected, right? It's mitigated by the fact that we have that senior secured first mortgage position, and we get paid back before the equity does, which again helps minimize the downside risk to our financing strategy. So, all right, sure. So we originally started out as Tremont Mortgage Trust, which became a publicly traded REIT in 2018. Small mortgage REIT, raised 60 some odd million dollars in the public markets. Then in 2021, we merged with another related entity here at the RMR Group in an effort to create a larger REIT, which is now branded as Seven Hills Mortgage Trust. Since 2018, done 56 transactions, $1.5 billion, average commitments about $27 million. I'm the president of the REIT since 2021 and chief investment officer since 2023. We like the REIT structure really because it's evergreen capital, meaning that as capital is repaid to us, we're able to reinvest that capital. Allows us to distribute 90 some odd percent to our shareholders, so they're getting a consistent income stream. The process of being a REIT and the benefits there really are consistent with our business plan of complementary financing. We're always able to be in the marketplace, always able to provide capital by recycling the existing capital. Well, look, alternative lenders like us are been increasing market share, right? That's really a function of coming out of the great financial crisis, and then even more recently, over the last few years, where we've seen stress in the regional banking system. we've been able to gain market share because we're seeing a continued pullback or hesitancy by the regional banks and the local banks. Those are historically have been the largest single provider of debt to the commercial mortgage markets. And with them sidelined or pulling back, it's increased our ability to gain market share. Also, there's just, by some estimates, there's $1.8 trillion of commercial mortgage loans that are coming due over the next few years. So we call this the wave of maturities or the wall of maturities. And it just provides us a terrific opportunity, again, for lenders that are similar to us and for Seven Hills to pick our spots and to see plenty of transaction flow in an effort to continue to grow our book of business. Short-term rates have declined from recent record highs. So borrowers are looking at floating rate loans again, saying, hey, look, I like the way that works compared to a fixed rate loan. It gives me more flexibility. Let me acquire the asset, rework the asset, sell the asset, and that works very well for our program. And with floating rates coming down, really puts us in a better spot. The bear thesis, there's still headwinds in commercial real estate, and in particular in office, right? We've all seen the headline news and continue to see the headline news, work from home, and what that has done to that sector. And we certainly have written office loans in the past. I push back on that, given that, look, all of our loans are performing. We believe we are at maybe through the trough here in the real estate cycle. We are seeing green shoots, certainly in office. I would tell you that multifamily and industrial have been overbuilt. However, again, the long-term secular trends there are strong. We still have a housing shortage in this country. We're seeing with the onshoring and the bring back of manufacturing to the states, industrial outlook remains very strong. We have seen hospitality bounce back quite nicely from the pandemic. So I would tell you that the forward-looking guidance from us is that we all things are pointing positively right now. High, strong, historical performing dividend provider, right? All of our loans are current. All of our loans are current on debt service. We've got a deep bench within the RMR organization, so I have unrivaled knowledge and depth of experience, which helps us protect shareholder value when we're looking at assets. We've outperformed our peer set for 2 years, quite handedly, actually. The company overall, we're under-levered. In our opinion, we're undervalued. Strong historical track record. Everything we do is done internally. From originating a loan to credit to closing a loan to asset management on the loan. Our interests are aligned with the shareholders. I think between insiders and management, we've got about 13.5% of the float. So we are certainly aligned with our shareholders.